Thank you. Well, thank you for that very kind, generous introduction, and thank you, ladies and gentlemen. Excuse me. I'm going to talk, in the time I have, I'm going to talk about a couple of aspects of the mining industry. I'm obviously not going to try to cover everything. This is a disclosure and so the first thing I'm going to talk about is problems in the mining industry. And you know, Cal did an excellent job in the last presentation of looking at some of the current problems in the mining industry. But when you think about it, mining is really a very, very difficult business, even in the best of times. If you were to design the ideal business plan, it would not be a company, a business with huge capex up front, with sometimes long paybacks, with high fixed costs, with assets that cannot be moved and are more likely than not in unstable countries. It would not be a business with highly variable prices for the sale of your product, and so on. Cal touched on some of these, but we know what some of the problems are. Reserve depletion, few discoveries. We've all seen graphs and slides of the number of major discoveries going down over time. I mentioned high costs, which might seem a little bit odd right now. But generally speaking, when gold moves up on any sustained basis, typically the price of the input, the price of the costs, such as energy, and the prices of the commodity currencies where most of these mines are located, also move up. Right now, we're in a very, very fortunate position where the price of oil is relatively low, and certainly the Canadian dollar, Australian dollar, Chilean peso, and so on are pretty weak. And so with the price of gold up over the last year and the price of the input for costs down, miners should really be making some money right now. And if they can't make money now, I'm not quite sure when they're going to. But we should look back to the bull market of the early 2000s, and from 2003 to 2007, when gold went from, I don't know, about 350 to 700, the margin on gold production actually stayed more or less the same. And that's because the price of energy went up and the commodity currencies went up. Anyway, and other problems there. I'll just look at a couple here, if I may, to add to what Cal had. This is the reserves at major miners falling. Now, of course, part of a decline in reserves is because of a price at which you value your reserves. But nonetheless, reserves at major mines are going down and going down fairly steadily. And another important factor is the time from discovery to production, which has been going up in a trend line for the last 25 years or 30 years. And largely that's because, or partly that's because of the increased time it takes to permit mines because of NGOs and other activities. But when you think of all these problems, some of which are inherent to the mining industry and some of which unfortunately have been added by incompetent management, sometimes incompetent management, it's really not surprising that you see return on equities very low. And in fact, for precious metals mining, this year or last year, returns on equity were negative almost 3%, compared with over 15% for the broad market. Now, it's worse than this because if you look at the last half century, the last 50 years, the gold mining industry has a negative return on equity. That means that the gold mining industry has been a destroyer of capital for 50 years. And of course, when you have an industry that is a destroyer of capital, it's not surprising the stock prices don't do very well on a sustained basis. I'm sure you've all seen this. This is the XAU, which is the North American gold and silver producers. The price of the stocks today is lower than it was in 1984. That is pretty astonishing, and I don't know if there are many other industries anywhere in the world or any markets, very few markets in the world, where you can say that the prices are lower today than they were 30 years ago. So the second thing I wanted to talk about, following on from this, is to really look at another way of investing in the mining business, and that, of course, is the royalty business model. And when I talk about royalties here, I'm including streams. So royalties and streams. This graph comes from Franco-Nevada, which is the largest of the royalty companies. And it looks at different factors, dividend yield, leverage, upside, and so on, compared with gold ETFs on the one hand and with operators on the other hand. Operators, of course, have greater leverage than does gold to the gold price. Operators have exploration and expansion upside, but so too do royalty companies. And I'll talk about that in a second. On the other hand, royalty companies have far lower exposure and theoretically zero exposure to capital costs, operating costs, environmental costs, et cetera, which mining operators, of course, do have exposure to. David Harquil, who's the CEO of Franco, likes to say that with a royalty, our first dollar in is our last dollar in, meaning once a company has purchased a royalty, they never have to put another dollar into that mine. They may choose to, but they never have to. If things go wrong, whether it's NGOs or taxes or pit walls breaking or whatever it is, the operator has to fix it, the royalty company does not. The other big benefit of royalty business models, which of course applies to some operators but not to very many, is the great diversity of projects, giving you, needless to say, reduced risk. So a company like Franco-Nevada, again the largest of royalties, I'm choosing the largest, has revenue from 37 different mineral royalties and streams. That's very broad diversification, and that helps again reduce the risk from any one operator, from any one country, from any one particular mine. I think because of these theoretical advantages to the royalties, you can see some practical advantages. This is the profit margin on the XAU over the last 10 years, and it's actually a little bit exaggerated because it includes the royalty companies that I've been discussing. But nonetheless, you can see that over the last 10 years, mining companies have lost money as many quarters as they've made money. Partly, the difference in the companies is because of margins. This is the margin of Franco-Nevada, and it would look as though it had a big dip down there in 2017, but at its low, the profit margin was still over 75%. Well, when you have a profit margin of 75% when it dips, that gives you a pretty good advantage in making money. And part of this margin differential between mining companies and royalty companies results from the very low G&A of most of the royalty companies. This is Franco-Nevada, and it would look as though it's been going up over the last 10 years, and you'd wonder, if I'm trying to show Franco-Nevada having a low G&A, why am I showing a slide that shows it going up like this? But the next slide answers that. This is G&A as a percent of free cash flow, and it's declined over that period that I just showed you from less than 15% to under 8%. That's G&A as a percent of free cash flow is less than 8%, which is, of course, considerably less than the mining companies. The other major factor between the royalty companies and the mining companies is debt. This is the debt of the mining companies. And the astute ones among you can see that it went up a lot. It started rising in 2011, 12, 13, precisely when the price of gold was high. So we all know why that was, because the mining companies, with very, very, very few notable exceptions, took on debt at the top of the market to buy marginal and sometimes uneconomic deposits. And in fact, if you look at the deposits that were purchased in 2012, 13, and 14, the majority of that money, something like 75%, has now been written off, not written down. That is really an incredible destruction of capital. But you've acquired assets, you've written them off, but of course the debt remains. The debt remains. If you compare that with Franco-Nevada has had two lives, two incarnations. It must be a Hindu or something, but that was a joke. Starting in 1985, it has had debt twice in its entire history, twice. Once in 2015, where you can see it took on debt to buy a huge stream, and 1 quarter later had paid off the entire debt. That's pretty phenomenal. It's just recently taken on some debt again. I'm not allowed to make guarantees up here as an SEC registered advisor, but I would be willing to bet that they'll pay that debt off very, very quickly. And then, of course, the third factor, I've mentioned debt, I've mentioned G&A and margins. The third factor is simply cash from operations. I'm not picking on any particular companies. Some of these companies we may actually be buying. But you can see how cash from operations, there's a trend here. And with Newmont, there's a trend here. And with Franco-Nevada, there's an opposite trend. And with Royal Gold, there's an opposite trend. Now, I don't want you to think that royalties are a panacea for everything. There are some disadvantages to the royalty streaming model, although I think to some extent they have been some of them have been exaggerated by the critics of royalties. But to me, the most important disadvantage is that the royalty company does not control the asset. Other people control the asset. And if a mining company has an asset in Argentina, or some country, and it decides that it doesn't want to build that mine, it wants to build a mine somewhere else instead, if you have a royalty or stream on that mine, you're out of luck for the time being. So other people control your assets, and they control, of course, how much they expand and how much they develop and so on. That can be mitigated, or has been mitigated recently, by royalty companies and streaming companies when they are buying assets from major companies, putting clauses in their contracts that say if this mine doesn't come on production within 5 years, then they get a certain amount of the royalty of the revenue they would have got from that mine from the company's other mines in other jurisdictions. So you can mitigate that. The second factor is not an unrealistic one. Royalties can burden projects. And in fact, even though I'm a huge advocate of royalty streaming companies for the investor, when I'm sitting in one-on-one meetings with companies and they're looking at their financing on small projects, I say, for gosh sake, don't burden this project with a royalty, not at this stage. I think royalties are more appropriate for larger projects, particularly where there is a byproduct. So you do the stream of a royalty on the byproduct and keep your main production unhindered. But nonetheless, if you're building a large mine, royalties are always something, or streams are something you should look at compared with equity or debt. Everything has a cost, of course. The third thing critics say is that royalty companies have no leverage, and that's just absolutely plain not true. Obviously, when the price of gold goes up, then the revenue from a gold royalty or stream goes up. But more importantly, when the price goes up, two things happen. Mining companies will do more brownfields exploration and expand mines over time, and royalty companies typically will try to buy a royalty or stream on the whole land around a mine. And in addition, frankly, sometimes projects become profitable many years after the royalty has been purchased. I think of Franco-Nevada that bought a royalty on the Deep Hemlo in the early 90s, and that didn't start paying until 2011. It's 20 years later. Now, during those 20 years, the companies mining it or operators had to put a lot of money into developing it. Franco-Nevada didn't have to put a single penny into developing it. So that's leverage. Now, I would show you a next slide to close, showing the performance of royalty companies versus mining companies, but if the SEC doesn't allow you to put up graphs of any slide of any companies that you own, so I can't do that. But I leave it to you to decide whether or not you think the royalty companies have generally outperformed the mining companies. Thank you very much.